Right then, good afternoon everyone. Another update from us at the end of another eventful week of trading. We end the week quite differently to the way we started. I mean, if we come back to last week and just have a quick look back to last week, I'll take you back to Friday of last week and a pretty strong upside day. As you can see here, this section of price here last Friday on the S&P 500. Quite an aggressive push higher, not really off the back of much in terms of the way of fundamental drivers. I mean, banks did kick off the Q4 earnings season last Friday and over the course of last week, and then the US did post relatively strong Michigan consumer sentiment data, and also the theme of the ongoing, or theme of the improving global growth situation off the back of China's reopening and increased Chinese demand, and also the improving outlook of the Eurozone, lending its support to the recovery or continued recovery of the global economy, which obviously markets were anticipating at the beginning in this year to be difficult, to be weak. Weak global growth across the year was the theme going into this year. But Chinese reopening and a couple of different banks, Goldman Sachs in particular, telling us that they predict the eurozone to avoid a recession, did spark some positivity over the last couple of weeks in financial markets, and that continued on last Friday. Hasn't really continued on into this week though. We see on Monday with a bank holiday in the US, so we had pretty thin trading conditions. Not a lot went on Monday in financial markets, but we'll come across to Tuesday, and Tuesday morning you can see some Chinese growth figures above consensus, industrial production figures above consensus, the unemployment rate ticked down in China. You had a raft of positivity across Chinese data on Tuesday, and you would think that would be supportive of global growth. Obviously, the Chinese economy is the second largest economy in the world, and any when we're in the midst of markets kind of coming into this year fearing for global growth with China's reopening and posting positive numbers, you would think that would spark a bit of a rally in risk, but that is not exactly what we got. We did push higher, slightly push higher, but you can see we did push higher up to the round number of 4,000 and back to this trend line that's a year old now. A couple of false breaks above 4,000 over the course of Tuesday, Wednesday. We never really managed to get above it, and then obviously we then pushed off of it as we come into Wednesday. Now we come into Wednesday, we did have a slight bit of positivity Wednesday morning with the BOJ with unchanged policy settings. We did see back in December of last year that the Bank of Japan did raise their upper band of their target range for the 10-year yield to from 0.25% up to 0.5%. And markets were kind of thinking to themselves, we may get some sort of a pushback on yield curve control, completely from the Bank of Japan. Maybe they might ditch yield curve control and then move forward. That would have sent the Japanese yen through the roof. That would have sent yields through the roof, and probably would have been a slight dent on risk sentiment, but that did not happen. And markets were slightly positive coming into Wednesday morning, but then we came into Wednesday afternoon and the negativity started to take over. Got PPI, producer price inflation. Sorry, I can't get my words out. Producer price inflation over the month of December, showing a substantial drop in the prices for the cost of producing goods, and also then retail sales itself, consumer spending at the moment, obviously down minus 1.1% after a further minus 1% move back in November of last year. Obviously minus 1.1% in December with the month of Christmas. There's obviously a slight drag on the economy with consumer spending also pulling back. Now that signals a bit of negativity in the US economy, which we're potentially expecting to avoid recession, but this kind of dampens those hopes a little bit with consumer spending, proving difficult with inflation still high. Obviously, you can buy less for your money, so that is understandable. But obviously, in order to grow the economy, we do need consumer spending, and markets did not take kindly to that. And then that followed into some hawkish speak out of the Fed speaker. So that kick-started the move lower. We'll come back to the charts in a minute. Retail sales PPI, difficulties for the US economy on Wednesday at 1:30 was then followed through by hawkish Fed speak from Fed's Bullard, who, although a non-voter, did say that he'd be in favor of a 50 basis point hike in February rather than the market's consensus of 25 basis points. So little bit of a tricky one in terms of that. We've had obviously strong Fed speak with strong hawkish Fed speak with a supportive of a 50 basis point hike rather than the 25 markets did hope for. We then get retail sales pushing lower, consumer demand staying weak, and then that was obviously a bit of a reaction off the back of that, with stocks downside off a fear for global growth. And we did not manage to sustain any upside on some potential positivity for global growth, which shows you the underlying sentiment then coming into Wednesday. And we pieced together a couple of things: some hawkish Fed speak, weak US data, further fuels those fires of a global economic slowdown, which pushed stocks lower over the course of Wednesday, sorry. And then we come into Thursday, and then further downside and risk then followed on Thursday after comments from ECB's, not that the ECB was planning to hike 50 basis points multiple times over the course of the first half of this year, and that the ECB were not entirely happy with the market's ideas that a slowdown in tightening was in fact on its way. They did push back on that. And then, if you just think about it, with the Eurozone potentially avoiding a recession, with Goldman Sachs being pretty sure they're going to avoid a recession, that does open up some more room for the ECB themselves to keep the foot on the gas in terms of hawkish rhetoric in order to cool down inflation, which positive for the euro, but obviously not positive for risk sentiment across the board. Oil did grind higher over the first couple of days this week. It's kind of chopped sideways since then, which is probably to be expected after we've seen some negativity step in over the course of Wednesday and Thursday. But it hasn't really pushed lower. And the fact that Chinese are reopening, if Chinese demand keeps continuing to grow, that should prove supportive for oil going forward, which could potentially see us through those highs at 80, kind of 81, 81.50 in that kind of region. Around here, as you can see, you will want to see it above there in order to sustain some further upside. But if you can see up there, decent bit of upside, to come potentially on oil if we continue with the rhetoric of the Chinese reopening, and if we get any positive data out of any other major economies like the US or the Eurozone, that should also fuel some fire for oil upside. The dollar remains flat, which is quite interesting. The dollar shorts are pretty overcrowded trade at the minute, so you're going to need something fresh to happen, something really fresh to happen for a dollar downside to continue. It is a very, very overcrowded trade. Maybe a push higher, a flush out of some of those shorts to get back short dollars in the future might be needed. So that's one to watch next week. Hasn't continued down, hasn't continued up. It's just chopped sideways off the back of some weak weak performance in stocks, with stocks then pushing lower. No dollar upside. I mean, when stocks start pushing higher and make another attack at that 4,000 round number, maybe potentially we can get through those lows on the dollar and keep that move pushing lower. We see some big treasury upside on Wednesday. Saw some big treasury upside on Wednesday with no change to the policy settings in Japan. That then pushed equities pushed treasuries higher, kept yields subdued. We then come into weak US data, which again pushes treasuries higher and keeps yields subdued. We then come into the hawkish Fed speak, which come into the hawkish Fed speak, sorry, which then sparked some upside in, or what am I talking about? Sparked some downside in the S&P 500, which sparked some further upside in treasuries. So there was a raft of different things, one with the safe haven, one with the Bank of Japan unchanged monetary policy settings, and then also with the weak data. Three things that ended up pushing treasuries higher on Wednesday. And if you're along some treasuries on Wednesday, you did pretty well for yourself. We'll flick back to the calendar. We'll come across the next week. We got a couple of things out next week. The major US data over the course of next week comes out the back end of the week on Thursday and Friday. We can see some durable goods orders, which is obviously an indication for the manufacturing sector and the economy, how that's going to fare going forward, how durable goods are being ordered. Any further update on anything to do with global growth, to do with the US as well from any of the Fed speakers, will obviously play a part. But these figures at the back end of the week on Thursday should prove fruitful in either direction if we are to find some trading opportunities. 1:30 on Thursday, worth having a look at those durable goods orders with the GDP figures. Weak GDP figures, weak durable goods orders means pretty easy downside, and stocks will then come around to Friday. Personal income, personal spending, not the most important, but then we'll come into the core PCE, the Fed's preferred mandate of inflation. That's predicted to rise, as we can see on Friday. And if you get weak figures with inflation still pushing higher, that is not a positive situation for risk that is likely to put a dent on stocks and may end up keeping keeping stocks under pressure and might present us with some opportunities to the downside. Apart from that, we get Bank of Canada out on Thursday. We've also got a fresh inflation print, the Q4 inflation print out of the Australians. Bank of Canada on Thursday, we're expecting to see a further 25 basis point hike and see what sort of predictions they can make for us going forward with the ongoing drop in inflation in that economy. But yeah, few opportunities this week, potentially a few opportunities next week. In terms of what that means going on into next week, we'll have to see how the news flow sorts itself out over the weekend. But there is a bit of negativity to end the week this week. Remember, at the beginning of the week, positive data out of China did not manage to push stocks higher. If something cannot rally off the back of positive data, well then that gives you an indication that you may potentially expect to move lower. We then get the hawkish Fed speak, weak US numbers, push stocks lower, which obviously was a pretty clear cut reaction. Didn't want to react higher off positivity, definitely wanted to react lower to negativity. So we'll keep that in mind as we head into next week. That's it from me then, folks. Enjoy your weekend. Have a good weekend, and we will be back next week for another update on markets. Have a good one.